All right, so let's begin the show. And we all know the markets has been sideways, clearly a very stock-specific movement and action that's been witnessed. But then, where's the market headed? And we get you a lot of experts to shed lights on what's on their mind, especially throughout the day. But then, what are the fund managers thinking? What is their take on strategy as well as their understanding of the current movement of the market? Let's decode all of this today. I have with me Karthik Kumar, fund manager, Axis Mutual Fund. Karthik, hi, good evening, and welcome to the show. Clearly, the market is sideways, a lot of stock specific movement that we are witnessing. But then, this is a time where investors can't decide or are not able to decode. It's time to enter the market or it's time to book profit if at all they are into any. As a fund manager, what is the kind of sense that you are making out of this current market movement? Do you look at it as a very healthy correction that was needed, which was overdue, and it's time for investors to just hold on for some time, take a pause, and then later on see as to if at all new money is to be put in the market?
Firstly, thanks for having me on the show. We need to put things in perspective, right? We are coming off a very strong 2023 and December 2023 in particular. So Nifty was up 21% for the year of 2023, and it was up just 8% alone in December. So I think it's very natural for markets to take a pause subsequently. And this is also healthy in a sense, as you mentioned, because it cleans up a lot of the froth. So I don't think it's unnatural in any way. Second is that there is also a seasonality thing to this. So if you look at starting 2001, the Jan to March quarter traditionally has been the weakest quarter for our market. So 54% of the time, the Jan to March quarter has resulted in negative returns, and the average return during this period has been around negative 1%. So there is a seasonality aspect to it. But there's a third angle to it, which is like the heavyweights, both from a sector perspective and from a stock perspective, have reported slightly disappointing numbers early in this reporting season. And so that also has contributed to the volatility. I think all the three factors together explain why our markets have been a bit sideways to slightly down over since the turn of the year.
All right, Karthik, specifically talking about valuations, because a lot of concerns regarding this has come up in the investors as well. Talking about mid cap and small cap, according to you, are they really in an overvalued zone? And the kind of volatility we are witnessing now, mid cap and small cap would be the first one to give up, and we will see the trajectory movement being shifted towards the large cap. In terms of valuation, how do you see it across market caps right now in this current market moment?
Okay, let's just break that down. So if you look at large caps, they are trading at 20 times, almost 20 times next year's earnings, which is not outright expensive on an absolute basis. But if you were to compare it to our regional markets, we are trading at a significant premium to our regional markets. Now, if you come down to mid caps and small caps, they are trading at their all-time highs in terms of valuation and on an absolute and a relative basis. If you were to look at their contribution to market cap, mid caps and small caps now contribute around 18.5% of the market cap individually. So that's the highest that they've ever contributed. So all these things highlight one point, which is that the asset revaluation or the gain through just expansion in multiples for the asset class, which is the mid cap and small cap, is pretty much done. What is important right now is stock selection. What has supported this expansion in multiples over the last year and a half is essentially the earnings differential was very much strongly in favor of the mid caps and small caps, and it was quite sizable compared to the large caps. Now, as we go into FY25 and FY26, that differential in earning growth rate comes off drastically. So again, in this case, what matters is stock selection and being very picky about stocks in these in mid cap and small cap. So just to kind of summarize, I think from a risk reward basis, large cap as a space looks quite attractive. But having said that, there are still opportunities in the mid cap and small cap space at a stock level.
Also, let's talk about the global trends, and then perhaps what kind of a new risk an investor needs to keep in mind. Because if we talk about the global trends, there are signs of softening economies, and concerns over inflations were not have not come down as we were expecting it, by the end of December 2023. So the scenario has quite changed over there. Talking about new signs of concern, or new risk factors, or those triggers that could just spoil, or just take us off tracks. What could those triggers be according to you?
So, firstly, as a house, we remain quite constructive on our markets in general, primarily because our GDP is quite resilient, and its expected growth rates, both from economic perspective, also from a market perspective, the growth rates are one of the highest in the region and also globally. So, we are quite constructive on the markets. Now, if you were to talk about as long as there is a softening in US economy, or a soft landing, and the European markets kind of experience a mild kind of recession, so that should result in benign commodity prices, and hence benign levels of inflation. At least the trajectory should come down, which should give central banks much more room to maneuver their interest rate policy. Environments like this typically are quite conducive for emerging markets, both in terms of flows as well as in terms of performance. So I think the macro environment, as long as it stays within the kind of spectrum that I've kind of laid out, should be good for emerging markets and our markets in particular. And from a style perspective, I think that the kind of style that should do well is like a GARP like style, where you're focused on growth at reasonable prices. That the kind of style that we follow within our investment platform should kind of do well. And from a risk perspective, I would lay out two main things. Primarily, the geopolitical developments in Middle East that could have ramifications in terms of regional stability, commodity impact on commodity prices, and also supply chain disruptions, which in turn could lead to inflationary effects globally. The other thing to keep an eye out for is what is happening in China, the government's efforts to kind of stabilize the economy and the markets. They are taking active steps, but it is just something to watch out to make sure that that is going the right way as well. So those are the two things that I would highlight from a risk perspective.
All right. Quickly, Karthik, along with this, let us talk about Access Quant Fund. And as far as the exposure across market caps is concerned, the kind of split that you've decided for the fund, it's majorly a large cap driven, where I can see a 66% exposure in large. Mid cap has almost around 18.5, and small cap around 14.2. What's the kind of strategy that you have opted for this kind of a fund? It's majorly large cap driven. If it is, how is it differentiating from the rest of the quant funds available?
Okay. So firstly, this fund is completely cap agnostic. So while there are broad ranges that it works in, basically it comes down to where is the opportunity, stock selection opportunity from a bottom up basis, and we are happy to go with that. So right now, the split as you defined is quite balanced. While it is around 60% in large cap, we have got sizable exposures in mid caps and small caps. The philosophy with regards to investment is we are focused on the style as I defined as I call it GARP, which is quality and growth at reasonable prices. That is what we are focused on. And in terms of our positioning today, we continue to remain bullish pharma. We continue to be bullish on automobiles, primarily driven by two-wheelers and two-wheelers ancillary industries. And we remain slightly underweight in financials, within financials, largely the big banks. And we are also we continue to remain underweight on the IT sector.
All right. Did you say you're underweight on FMCG and IT sector right now?
No, I'm underweight on the financials, largely coming from the
Okay.
big banks and the IT sector.
Financials and IT sector, sectors where you are consistent as far as your exposure is concerned.
All the other sectors barring, so I've highlighted two. So I overweight pharma, I'm overweight consumer discretionary, and I'm overweight the power plays. And the other two sectors that I highlighted were largely the underweights, and the rest I'm largely in line with the markets.
Going ahead, for a few more quarters, as far as FMCG space is concerned, because we have triggers like budget and we also have triggers like the elections coming up. Although it won't be feasible for you to just change the strategy owing to these triggers, but then I just want to understand in coming quarters, do you see banking on sectors like FMCG, healthcare and power especially?
Mhm. Hello.
Yeah.
Yeah.
Yeah,
So
Karthik, go on. Sure.
yeah.
Yeah.
So with regards to FMC, with regards to power and healthcare, we remain quite constructive in both those sectors for fundamental reasons, and that comes out through the Quant model as well. With regards to FMCG, I would be much more selective within that space and go for stocks where there is reasonable visibility in terms of growth. Because right now in FMCG, what we are seeing even through the earnings season is that the with the companies that have reported so far, the volumes have been quite subdued, and so the numbers both at a top line basis and a bottom line basis, while they have been in line, they've been nothing great to write home about. So that's something to keep an eye out for. The commentary so far has been quite tepid from the companies that have reported as well. So those are the things that we would keep an eye out for. And if the sentiment does change, if the outlook does change, then happy to align our portfolios accordingly. But so far, it looks like there could be better opportunities down the road.
All right. I think that will be all because my time is up for this discussion today. Karthik, thank you so much for being on the show and helping our viewers with the market trajectory and also the fund in specific questions. Thank you so much.
Thanks a lot.
We move on to take a quick break, and post that, let's get our viewers on board and let's solve their financial portfolio queries live on the show. Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and let's get our viewers connected. And to do their live financial planning today with me, I have Hemant Ustigi from Wise Invest. Hemant, good evening and welcome to the show. And I also have our first viewer connected on the phone line with us, and I have Harshit with me today. Harshit, hi, good evening.
Hi, good evening.
Hi. You're calling from?
I'm calling from Lucknow.
Lucknow. All right. Harshit, you have invested in a couple of funds, which is Canara Robeco Large Cap, Parag Parikh Flexi Cap, Kotak Mid Cap. You have Quant and Nippon Small Cap, and you have Motilal Oswal Nasdaq 100. Total SIP amount is almost 12,000, and you want to invest for 7 to 8 years. That's it?
Yeah.
Okay. Any specific reason why you think going for a balance advantage fund will be good for you? Because you have a time horizon for 7 to 8 years, which means you can take quite an average amount of risk.
Yeah, that is what I wanted to ask as well, since Flexi Cap also have a large share bias to it, basic, and also the Motilal Oswal Nasdaq fund is also like pretty much large share oriented only. So that is
Sure.
why I wanted to ask, just for like a more balanced portfolio. There was curiosity if I should go for it or not. So that
Got
is why
it.
I asked.
Got it. And you are also expecting a CAGR of 15%. Also, one very good thing is you are just 28 years old and you have started, your investment journey already. So, congratulations for that. But then let's get Hemant on board and let's understand as to having a balance advantage fund would be the right strategy for you or not, considering that you already think you are very well exposed in a large cap category. Hemant?
Well, Kavita, I think in this case, since Harsh's time horizon is 8 years, so investing in equity fund through SIP, I think is a good strategy. So let me just address the issue of where he mentioned that he's expecting a return of 15% annualized. Well, I think we always advise that it's always good to be a little conservative in terms of what you expect from your returns. So it's always good to maybe look at around 12%. Yes, indeed, if you invest for 10, 15 years through SIP, it is possible for you to get 15% also. It has happened in the past. And I'm sure it can happen in the past, but I think it's good to be a little conservative and expect return of around annualized return of 12%. As for the composition of the portfolio, I think currently there is a large cap, there is a flexi cap, there is a mid cap, there are 2 small cap, and there is 1 global fund. There is slight bias towards the large cap, I agree. But I don't think it's a great idea to go into a balanced advantage fund, because what happens there is the allocation to equity will come down and it will keep changing in line with the market valuation, which I don't think is the right strategy for a time horizon of 8 years. There is indeed a scope to include, a large and mid cap fund. I like this particular category of fund because the fund manager can actually pick and choose out of top 250 companies in terms of market cap. So maybe he can kind of stop SIP and Canada Robeco large cap fund and consider Motilal Oswal large and mid cap fund. So one change, as I mentioned, balanced advantage fund definitely is not the suitable category for this kind of time horizon.
All right, let's move on, and quickly a small question, Hemant, which is from Aditya, and he has a lump sum of 10 lakh rupees to invest for a period of 5 years, and he wants to invest in a debt and arbitrage fund, as he's already invested and well diversified in equity funds via SIP. He wants you to help him with debt funds and arbitrage funds, and whether that will be the right choice for him.
Well, I think it's always a good idea, Kavita, to actually look at your time horizon for each goal and then decide where you should be investing money. In this case, 5-year time horizon actually is a decent time horizon. But since he wants to look at arbitrage and debt, let me just explain that to him. That arbitrage is a great, a category to basically park your fund maybe for 12 to 18 months. But I don't think it's the right category to invest in for a time horizon of 5 years, because that's a decent time horizon to get healthy return for yourself. In the debt category, if he's keen to invest, there are 2 categories of debt fund. You can look at PSU debt funds and banking, and the banking and PSU fund, and the second one is the dynamic bond fund. The reason why I'm saying is because we are expecting the interest rate to go down after some time, so maybe a dynamic fund will be a good category. So he can look at DSP strategic fund in that category. But my view is that for a time horizon of 5 years, with little bit of risk, maybe equity saving will be a good strategy to invest in, because there 20-25% goes into equity, the rest is in arbitrage and debt. The taxation is of equity as against the debt, where you need to pay short-term capital gain, which means that you have to pay tax at your applicable tax rate. So your post-tax return can be better. You're not taking too much of a risk there. So 2 funds in that category, if you want, you can consider a Kotak equity saving and SBI equity saving. So I personally feel that equity saving will be a better category as compared to a debt fund.
All right, so that's a word coming in from Hemant for Aditya, and with that, it's a wrap today. Thank you so much, Hemant, for being on the show and helping our viewers with their mutual fund queries. And I'm going to sign off, but I'm going to leave our viewers with our WhatsApp number and email ID, where we keep waiting for your questions, and this is the only show where we do your complete financial planning live. Thank you so much for watching. Goodbye.